Hey everyone, and welcome back. In the last video, we spoke about the 3 circles of volatility, in which we really came to understand the different areas that volatility impacting our stock and our options can come from. It can either come from the market, from the regular day-to-day movement of the stock or the non-event volatility, or it can come from the event volatility. Now that we understand these concepts, we're going to dive one step deeper and talk about the implied volatility versus the realized volatility. Now, this is a concept that we're going to be able to really grasp by the end of this lesson because it's really 2 simple things. The implied volatility is simply the volatility that the market thinks there is going to be in the future. And the realized volatility is the actual volatility that ends up happening. So here's a quick example to help you really wrap your head around this concept. Imagine you're at a horse racing track and you do a ton of research and you look at all the different horses that are participating in the next race, and you come to the conclusion that Seabiscuit has the best chance of coming in first place. And you think that there's a 4-to-1 odds that Seabiscuit places in first, or at least in the top 3. So you place a bet based on that view that you have. You think that this is going to happen in the future. So you place your bet. But then the race actually starts and we see what happens. Maybe Seabiscuit does come in first place, in which case it matches your view and you're going to make money. Or maybe Seabiscuit comes in last place. But either way, what happened before the race is what you thought was going to happen, or what you thought the statistics were implying was going to happen during the race. But then you had the actual race that happened, the realized occurrences in that race, what actually ended up happening. And that example is just to illustrate for you how when we're looking at implied versus realized volatility, we're doing the same thing. We're looking at what the market thinks is going to happen in the future. And then as the events occur, we're going to see what actually happened, or the realized volatility, the real volatility that ended up happening as the events unfolded. So let's break this down one step further. In order to really break it down for the option space, we're going to have to start with a timeline. So imagine we're looking at an option for, let's say Apple. And we're looking at trading the 30-day to expiration options, right? So we're looking at trading an options contract that expires in 30 days. Well, let's say that we look at what's in the next 30 days and we see a couple of different things. For example, we see that right here, there is an earnings event. And we look at the market, we understand how things have been moving, we have a good understanding of how Apple moves, and we look out into the market and we see a couple of different things. So looking at this timeline, what we know is that all 3 forms of volatility are going to be present in this timeline. Because we have the regular movement of the stock, right? We have the regular day-to-day movement. We have the overhanging market, which obviously impacts every stock within it. And we also have this earnings event here. So all 3 forms of volatility are going to take place within this timeline. And what's going to happen is the market from here is going to look forward and try to determine what impact all of these are going to have on the stock within the next 30 days. And depending on the impact that the market forecasts in the future for this stock, that is how we're going to determine the price of the options. So let's say that the market comes out and they do their analysis, they look at how much it's going to move, and they come to the conclusion that there's going to be 15% volatility in the next 30 days. We would see that the calls and the puts are actually going to be priced as if there's going to be a 15% move in the future. And that's fair. Based on all of this, the market thinks that there's going to be 15% move in the future, so it's only fair that the calls and the puts are priced accordingly. Let's see here. How does someone actually make money buying something that's priced at how much the market thinks something's going to move in the future? The reason you can make money trading these is because the market doesn't always get it right. In fact, they often get it wrong. For example, as we start to move out into the future, this is the volatility that the market thinks there's going to be. But we might actually see volatility like this. It might actually be a lot smaller, in which case this 15% implied volatility should actually be maybe 2%, which means that these options are really expensive. Or we could maybe see volatility like this, in which case this 15% option is extremely cheap. Maybe it should have been priced at 30%. This is the difference between the implied and the realized. It's actually where money is made in the end of the day. Because as the realized volatility starts to show itself as we move forward in time, these options start to change in price. And that is how we make money moving forward when we're holding an option. We may not always hold it to the 30 days, but because this volatility will start to show itself earlier than the expiration, we can make money and close it out maybe after the earnings event if we think that that had way more volatility than it should or way less volatility than it should. But the whole point of this is to really understand that we're all here looking forward. The market is here with us too. And what we're trying to do is take into account all of this, bring it back here, and determine a price. What ends up happening is the realized volatility. This entire analysis, and what you actually will see in the market as the price of the options, is the implied volatility. And here's what's really cool. What we're going to be doing moving forward is we're actually going to be trying to challenge that implied volatility and try to determine, is this a fair analysis of what this option should be worth? Or if we do our own calculations, if we do our own math and our own research, do we come to a different answer? Do we look at this 15% implied volatility and think maybe it's too high? Maybe it should only be 10%. In which case, the option based on 15% implied volatility is really expensive. It should be cheaper than what it is because we think the stock is going to move less than the market thinks it will. Or maybe we think the opposite. We think that it should actually be priced at 20% implied volatility. In which case, this is a really cheap option and we should go out and buy it. This is the way that we're going to be thinking about options moving forward. The implied versus the realized. And what we'll be introducing down the road, a third kind of volatility, which is our forecast of volatility. And this is what we're going to compare directly with our implied to find where we have a disagreement with the market. And then to find out if we were correct or not, we'll see what happens with the realized volatility. Who had the better predictor, us or the market? And it's through this forecast that we find our expected value. And if we have a positive expected value of comparing our forecast to the implied, we're actually going to come out huge winners in the end of the day. So there you have it, an in-depth explanation of implied versus realized volatility with a brief introduction to our own forecast of volatility. Now to move forward, we're going to go into some volatility characteristics, a little bit of how statistics and volatility come together. Remember, when we're trading options, we're playing a probabilities game. So we need to understand the stats that go into something like volatility. With that kind of an understanding, we're off to the races. We'll see you in the next video.